Also, I would like to thank Euronext for hosting us today. And so I will pass on the floor for you introductory remarks.
Thank you so much for passing me the opportunity to welcome all of you, those who are present here in the room, those who are present virtually or in the hybrid mode. Really delighted to welcome you in our offices today for this session. I think that our common objectives are quite aligned. Wealth can be created. My predecessors said those who don't invest in shares, they get poorer in the long run. And the big way to simple way to create wealth on the long run and to have something complementary to your pension is to start saving and investing in diversified funds. But also the large pension funds, they can allow seeing yields for today's employees. It's also because those pension funds invest into stocks and into a diversified number of securities. We at Euronext, what we try to do is to create the pan-European exchange, and we are now active in 6 countries. And we have since the start of this week, we have added to the exchange also the clearing house, and so all the transactions in equity which take place on Euronext venues are cleared through Euronext clearing system. And so we really want to make this capital markets union live. And these are the different initiatives that we take, and we will probably be quite bold on that in the coming years as well. So very warm welcome to all of you, and I hope you will have a fruitful one session today.
Thank you very much, Mr. Wilbur. So we will start with the roundtable. So first of all, I'd like to thank all of you present here and online for agreeing to exchange your views on this important issue. For the first roundtable, we will hear presentations from the different roundtable. So we will start with an introduction by Alexandra Mikilska, Managing Director of Finance. Then this will be followed by a presentation of this year's findings, the Finance Pensions Report by Sébastien Comin, Research and Policy Officer at Telefinance. Then first of all, before moving on to introducing the next speakers, you will all find a copy of the executive summary of our pensions report, which will be published today and available online today on the website as well. So, following Sébastien, we will have a presentation from Valerie Wood, Head of Consumer Protection at EIOPA, who will lay out the findings of the EIOPA's cost and task performance report. Then we will look into 3 specific country cases, starting with France, which will be presented by Euronext Finance. Then we'll look at the situation in Sweden. This will be presented by Johan Florin of Sweden's AP7. And then last but not least, we will have the Netherlands presented by Matthijs Stegen of the Pensioenfederatie, the Dutch Federation of Pension Funds. And just little remarks, is we just have 2 hours, and since we would like to have a debate as well, I would like to ask you to keep your presentations to a maximum of 10 minutes. The floor is yours.
Thank you. I'll be shorter. So, can you afford to retire? Will you be able to retire? If you read the finance report that will be published today, the answer is much likely to be no today than it was some years ago. The outlook for many savers in the EU is quite gloomy, and we will be discussing this today. With the shift from the defined benefit pension schemes to defined contribution, the risk and the situation for savers is even more uncertain. To that, you need to add very, very low and sometimes negative real returns that our report is reporting on. And this all makes the outlook really gloomy. However, in our report, we have also, would say, the light at the end of the tunnel. There are some countries in which pension savers can sleep with less stress and be a bit less worried about living in poverty in the old age. And some of those cases will be discussed today with our guests online and here in the room from the Netherlands and from Sweden. The problem right now when you talk about pensions is also that quite often it is difficult to find the information about the costs and charges. And this is also the case for our report this year. So we find it increasingly difficult to find available public information, especially for some countries. And this is also the reason that this year we do not have and cannot report anymore about the Bulgarian country case. As Arnaud said already, we would be discussing the reporting issues, and also we would like to hear about the EIOPA's cost and past performance report. But Finance Impact has been advocating for such a report for a long time, and when we saw the mandate from the European Commission to the ESAs, we were quite happy. But even the European supervisory authorities are struggling with getting all the necessary data, and EIOPA during the first reiterations of this report has been underlining in the opening remarks and in the introduction that unfortunately the reports were not that useful to the pension savers, but rather to the supervisory authorities. And we really hope it's going to change, and that the reports from the ESAs are going to be even more useful to the savers in the future. Since we have a lot of participants that were already ahead of the seminar worried maybe not enough time for the questions and answer sessions, please don't worry, we will have enough time for that. And in fact, if there is any very pressing question just right after each of the presentation, really focusing on the content or some of the participants trying to understand better the presentation, I would say we can allow one question after each presentation. And then at the end, we will have enough time for the Q&A, so please stay with us. So without much further ado, I will give the floor to Sebastian Holland, who was our main expert on the report that was really on the front line. So over to you, Sebastian.
Okay. Thank you, Alexandra. So I will try to be brief. That's a long report. Yes, and I will speak loud. So just very brief introduction to this report. It has a new title, but that's the 11th edition of the long series that started 11 years ago, called in that time the real return. I don't maybe know that the definition is the same. We want to inform savers about the average returns, costs in their country out of the product they pension saving, so that they can compare products in their countries, different countries, both about the opportunities that they offer to them in terms of savings, and also be aware of what may be dysfunctional in their pension system, and as citizens as well as consumers act on it. So as Alexandra already mentioned, now the ESMA and EIOPA do their own cost and report, which we welcome, but we still believe that the finance report is unique. We look at all providers in product category, now the sample. We distinguish between the Pillar 2 and Pillar 3 of pension systems, which post the reports by ESMA, EIOPA, and the OECD not. And with both the 11th edition, we now have up to 23 years of data on returns, cost and charges, and asset allocation. That's of course the best case. In many cases, we do not have those 23 years, but we try to acquire those data to have a long-term perspective. And finally, we always try to give a clear and concise description of pension systems, including the pillars, so that savers can know how the interaction between public and private pensions, which we believe is very important. So for this year, as Alexandra mentioned, we cannot report on Bulgaria, unfortunately, so that leaves us with 16 countries. And in those 16 countries, we have 43 other categories that we have for returns. I say 43 product categories. Initially, it was 46. That's in this very country, in Belgium, we cannot assess the returns of life insurance. So it's 3 products less. We have 21 products in Pillar 2, so the occupational pensions, 22 voluntary pension products, and performance data ranges from 3 years for one product in Poland to 23 years for a number of products that we've been following for now 10 years. So, without much surprise, 2022 was a catastrophic year for investors. The average nominal return was positive for only 6 out of 43 products in our sample. So the best performing product last year only got plus 2.2%. The worst performing product was at minus 21.5. Of course, that doesn't mean that over the long term, those same product categories had bad performance or good performance. 2022 was an exceptional year for 2 main reasons that you're probably aware of. First is that capital markets plunged, and exceptionally both bond markets and equity markets went through a downturn, which, as you can see in this graph where we show our benchmark, hypothetical benchmark portfolio made of 50% equity, 50% bonds, meant significant loss for all savers. The second reason was inflation that started increasing significantly all over Europe in 2021 and peaked in 2022, with an EU average at over 10%. With great variation across European countries, it was really low in Spain, still higher than its long-term average. But in other countries, in Latvia, it's plus 20, over 20%. So as you can see on the graph, all over Europe, inflation was higher, reducing mechanically the real net returns for 2020. So that led to major losses in real terms, of course. So rising inflation further compounds the poor performance of the capital market. And when we look at the real returns of the products in our study, all of them were negative last year. Not particularly surprising finding, but striking to see it visually. Now, if we move to a long-term perspective that really aligns with the long-term time or investment horizon of pension savings, well, we'll still see that performance of the whole sample of products that we analyzed is rather disappointing and problematic in terms of pension adequacy. We have negative real net returns for 16 out of 43 product categories on their maximum reporting period, which can range from 3 years, of really long term, to 23 years. The majority of our products are at least, for the majority of those products, we have at least 15 years at least. For 10 years, which is more representative, we have negative real net performance for 12 out of 44 products. And I showed earlier the capital benchmark, like hypothetical capital benchmark that we compute. Only 12 out of those 43 product categories beat their capital market benchmark, calculated for the same reporting period. Now, who performs best? Well, the best performing over 10 years is Sweden's 87 SOFA pension plan, which is officially categorized as a Pillar 1, but really functions as an occupational product. And I'm particularly curious to know more about 87 SOFA, how it works, and what makes it different from other occupational plans in the European pension landscape. Secondly, like to remark that occupational schemes generally perform better than voluntary products. That's true. The main reason that we can see from the data that were collected is lower costs. A short review of performance drivers. What we see when looking at adaptation across the different countries where we have data, which is often difficult to come by, is that fixed income assets really dominate the investments of most of the analyzed products. Despite the very long-term horizon that would make it possible to invest in more risky products for younger generations and then slowly move out of equity markets to invest more in bond markets, so a life cycle approach. What we see when we look at our best performing product, it's so far in that it's a that implement a life cycle approach and invest all the assets of an individual into equity until the age of 55, then progressively transfers roughly two-thirds of those assets into a fixed income fund, and but still keep a third of assets into equity after retirement until basically death of the beginning. So, a heavy investment into equity, that is quite the contrary to what we see in most of the other products in our study. Now on costs, I stand next to a representative of the Dutch pension federation. So I will say that the Dutch pension funds are quite an exception to that finding that data on costs is scarce and hardly comparable. There are some product categories, some industries that make great efforts to harmonize and clarify that the reporting framework that is very much welcome. But in most of the product categories that we analyze, we still have troubles to find data that can be aggregated at the level of the whole product category, the whole industry. Often we have different parameters and different scopes and different definitions of the same variable. So it's really hard for our contributors to collect data on cost. So we, in the end, have data for more than one, for at least one cost item in 2022, only 28 to 46 product categories. So including Belgian manufacturers, which means that when it comes to assessing the weight of cost and charges on performance, our study is incomplete because there are products where we have to start with nominal net returns and not returns before charge. Now, some good news on the level of costs. When we look at the distribution of average costs for product categories over time, we have year 2000 on the left, for 2022 on the right. We see that the median, the middle of cost, increased until 2013, but has significantly decreased since then. So we see a trend towards cost reduction. There are still very expensive products. As you can see, the 6 points that are in the upper part of the graph. But the median value for all products in our study is decreasing. But looking further into that, what we see is that the median value of cost of pillar 3 products is structurally higher than that of pillar 2 occupational products. Here on this graph, you have the line, the curve at the bottom is occupational products, and the one on top is voluntary products of pillar 3. Is the one that you as an individual buy through your financial intermediary. And we see that this difference in median value of cost remains over time, despite the trend towards cost reduction. Now, very quickly on taxation, most of the products that we analyze are subject to a deferred taxation regime, either PBT or ETT, meaning that contributions are exempted from tax. Investment returns may or may not be taxed, and pension payouts are taxed. So that's is a good incentive to save because it reduces your taxable income in your working years. But the problem with that is that the tax is calculated on nominal pension amounts, which have been depreciated over time by inflation and significantly. We've seen accumulated inflation. So, coming to conclusions, I said that most of the products that we analyze do not generate sufficient real net returns to significantly improve savers' retirement income. So, when it comes to pension adequacy, a large part of the European private pension landscape is not in a position to supplement or to replace public pensions. Costs are often eating away a very significant part of the returns. And we see investment policies that do not generate sufficient nominal growth returns before charges and before inflation to compensate for those costs and inflation. So although we see that the level of cost is decreasing, there are still many expensive products, especially in Pillar 3, which are products that are structurally more expensive than Pillar 2. So, you are probably aware of the discussion on the return investment strategy here in Brussels and the the distribution of return investment products. So we asked, is there a problem with the distribution of those products? Is it a question of distribution costs that are structured higher for Pillar 3 products than distribution of funds? I have my idea about that, but I think our speakers will give their opinion. And then we have a big issue of transparency, accountability, and benchmarking. We would like very much to see more details about the costs, historical data, just an explanation of what the amounts that are communicated when they are communicated stand for. What is administrative costs? What is asset management costs? So, we see some parts of the financial industry making big efforts to harmonize the different ways in which individual product providers communicate, and we welcome that. We encourage that. We would really much like the whole industry to join and be supported by supervisors. So thank you for your attention, and I give it forward to you.
Well, yes. Thank you, Sebastian. But perhaps we can keep questions for after the presentation because we are slightly not running over time yet, but we might better pass on to the presentation by Valerie Marianne Wood right now. Valerie, I give you the floor.
Very much. Good morning to you all in the room, and good morning to everybody online, and thank you for inviting EIOPA to give an overview of the situation at EU level. So if we can go to the first slide. I would actually like to start this presentation by giving an overview of consumer confidence, and I'm talking specifically about financial confidence in their retirement, i.e. the confidence that when consumers get to retirement age, they will have enough money to have acceptable standards of living. And if we look at the numbers at EU level, I have to say that the numbers are not particularly impressive, where in 2022, fewer than half of EU consumers had this level of financial confidence in their retirement, with only 45% feeling confident. And to add insult to injury, this percentage is dropping. We have lost 3 percentage points between 2023 and 2022. So as an aside, I'm talking here about the Eurobarometer that EIOPA will be publishing in January 2024. That's where these numbers come from. And not only is the percentage dropping at EU level, but if you look at the gender gap, you will see that it is unfortunately very persistent, with only 37% of women having this financial confidence compared to 47% of males. And of course, the global situation, and which explains this level, these low levels of confidence, is that the penetration of pension products and services is still pretty low across the EU, with an average, all genders together, of only 23% of EU consumers having an occupational pension scheme. So that's a Pillar 2 scheme linked to employment, and even lower when it comes to a personal pension product with 19%. And unsurprisingly, consumers who have one of these products, whether it's an occupational product or scheme, or whether it's a personal product, have a higher degree of confidence. But if you look at the numbers, it's still not that great either. You're just above 50% as opposed to just below. So I think these scores need to be taken really with an overall concern that clearly people do not feel that they will have enough money on average for their retirement. So we can have a look at the reasons for this situation, for this low confidence. And I would like to start with costs, if we can move on to the next slide. So looking at cost, I have 2 slides here with numbers, and the reason is that I have a lot of data on IBIPs, and as you know, in many member states, IBIPs are actually used as pension provision product, as Pillar 3 products. So I think it's important to have a look at that. And the reality of our findings is that over the long term, you can see positive returns if you look at the elapsed 5 years, with of course a big drop in 2022, as Sebastian was explaining earlier, because during that year we have both equity and bond markets tanking, high inflation. So all we needed really was geopolitical instability. Well, actually, we had that as well, and that probably explains it. So in this way, 2022 is indeed an exceptional year, but the effect it had on returns on IBIPs is quite dramatic. So we've had a look to see whether there was some product sensitivity in this category, and we've had a look at unit-linked versus hybrid products, for example, in terms of the performance, but also in terms of costs. We've also had a look at whether unit-linked product was a high, as in long, recommended holding period, had a better ability to bear losses and a better overall return. And there seemed to be some correlation to the effect that products with a longer recommended holding period tended to have a somewhat better return. And if we look at the split between IBIPs, the unit-linked, versus product profit participation products, you do observe what you expected, what you would normally expect, which is that unit-linked have suffered in more stronger digits than the profits participation, where there is a bit of a lag effect when it comes to reflecting the the volatility of the capital markets. But in terms really of the cost, the overall picture is that the costs remain high for these products, and they are slightly higher for unit-linked products than they are for profit participation. But the situation is not evolving that rapidly. So these costs are not only high, but they are pretty persistent. And that indeed is an issue, because yes, the impact of inflation will of course eat up some of the performance on the products, but the costs are a major source of consumer detriment, unfortunately, in the IBIT market in unit linked. So the compound effect of stock market volatility, inflation, high cost means that in real terms, the returns were negative. If we move on to the next slide, the next set of numbers is more focused on actual pension products. So these would be personal pension products, as in Pillar 3 products, because we unfortunately have quite severe data quality issues on IOPS, so on occupational products or schemes. And the high volatility also poses a concern for these Pillar 3 products, which often have, but not always, life cycle strategies. Now, if they have a life cycle strategy, that will generally be used to dampen some of the volatility, but they do not all have it, to the result that the net returns can also be affected. And although costs are slightly lower than for IBIPs, for example, the costs have remained pretty stable over time. And we had observed a decrease since 2018, but that seems to be slowing down or even receding. And the best guess for this recent trend is probably that what we are seeing is the impact of inflation, the impact of inflation on the cost of the manufacturer, quite simply. So we can derive these trends, but may I say again, I need to qualify my intervention here, because the products are quite different from one member state to another. So that makes the comparisons quite problematic, and probably not as easy or not as reliable as the data we're getting for IBIPs. So again, we can observe high-level trends, but we should not be driving too much from that. Now, if we move on to the next slide, I'd like to talk about some of the possibilities, some of the ideas to actually close the gap. So, in other words, what is EIOPA working on in order to address this situation? And I guess the first one is so obvious. It's simple. Is clarity. At EIOPA, we believe that it is essential to empower consumers by very simply telling them what the situation looks like in terms of their particular savings and savings for pensions. Also, make sure consumers understand one of the recent trends that is, of course, a direct effect of inflation, which is the shift from direct benefit to direct contribution, because these schemes are simply unsustainable in the current circumstances. I won't bore you with the demographics. We all know it, right? There is a pension time bomb in Europe, so we can repeat this till the cows come home, but that's not going to change. So what EIOPA has been focusing on is really providing advice on the different tools that could be put in place in order to give greater transparency to consumers in terms of their own pension situation, because the reality is, in a number of markets, consumers might be saving in different pockets, so to speak. They will, of course, have the Pillar 1, the state entitlement. There might be members of an occupational scheme by virtue of their employment. They might hold as well a personal pension product, whether that's an actual pension product, whether that's an IBIP that is being used for pension provision purposes. But what they don't have is the overall view. So it's complicated to raise awareness when consumers do not actually know how much money they currently have set aside, let alone the projection of what this could mean when they reach retirement age. So in terms of a projection or even a projection of the annuity that could be paid to them. And if I look at some member states, you actually get this information on your state pension extremely late. I have an example where consumers, citizens of a certain member state will be allowed to inquire as to their state pension when they reach 55. 55, that is way too late. That is way too late to start saving, maxing your contribution in an occupational scheme, or even subscribing to a private pension product. So it's not just the information that's lacking, it's the timing that is counterproductive in our view. So one of our recommendations is this, some sort of tracking system so that consumers can have a view at least of their current entitlements and ideally of their future entitlements when they reach retirement age. But also we've been advocating for pension dashboards, and these dashboards are really meant for member states to assess the sustainability and the viability of their current schemes. But of course, this is extremely politically sensitive because it's a fine line between raising awareness and nudging consumers to take action and alarming them as to the potential fragility of the pension system in a member state of residence. If we move on to the last slide, and I think because I'm running out of time, the other thing that we are working on is, of course, costs. And that's all the work we're doing on value for money. So in 2021, we issued an opinion to NCAs to really emphasize that, raising awareness, incentivizing consumers to save is all very well, but there is a significant issue with pension products with high cost, because if you take just a simple mathematical example, an annual cost of, costs and charges of 1% per annum over 40 years, that's 20%. That's a large chunk of your pension pot. So there is an urgency to address these high costs in order to protect consumers investing in these products. And you are, of course, aware more generally of the work we're doing in the context of value for money and the benchmarks. Now, I won't repeat everything I've said in other fora, but the basic principle is that EIOPA is working on tools to address value for money concerns, and benchmarks are one in particular, where EIOPA started working already a couple of years ago. We will be consulting soon on the methodology, but these tools are really meant for the industry and for supervisors to address these pockets of consumer detriment, which again are extremely detrimental in the long run. So this is why it's an increased area of focus and a very topical subject for today. And with this, I will hand over, and I apologize, I've been a little long. Over to you, Sebastian.
That's good. Normally it's good now.
Do you all hear us?
We can hear you, yes.
Okay, sorry for the technical issues.
So, yes, apologies for the technical issue. If there's one burning question for Valérie, we will allow one question right now. Otherwise, we will move to the next presentation by Guillaume.
Okay.
I'm
So,
happy either way, it's up to you.
okay, so maybe we have questions at the end. Good morning, Guillaume Brush from Better Finance. I will try to be very quick. I have only 6 slides and it's only facts. So we can then keep the recommendations of Better Finance for the discussion. So what's the landscape in France? As Sébastien said, it's a quite diverse landscape in the EU. In France, this is not even on this slide, 65% of French savings are in real estate to start with. And that is also used, as you can imagine, for retirement. On the 35% that are financial savings, as you see, a lot is in bank accounts and a lot in life insurance and pension funds. But actually, you will see in the next slide that pension funds are very small. It's mostly life insurance. And that is why Better Finance is including life insurance in its scope, because it is used, for example, in France, but not only in France, massively for retirement purposes. And then don't look too much at the direct investment number, because in fact, if you take out private, non-listed equity and bonds, and mostly equity owned by entrepreneurs, we are down to about 7% only in listed stocks and bonds. If I look more precisely at the purely retirement driven assets, savings, as I said, it's mostly life insurance. You have capital guaranteed insurance in dark blue, which is close to 1.5 trillion euros in assets. It is capital guaranteed insurance. I know EIOPA keeps calling them the UK way with profit policies, but the main feature of these products is that profits we don't get too much, but capital guaranteed, yes, it's the key feature. Whereas the other light blue piece, which is growing a lot these last few years, the unit-linked insurance, is also with profit. We can get profit sometimes. You will see you can get sometimes also a lot of losses. Is about less than 500 billion of assets, but growing. We could not put the whole series of pension funds here because we don't have yet the historical series, but as you will see, maybe for some of you who have good eyes in the footnote, there is 162 billion in long-term defined contribution corporate plans and growing, but still that's about 7 to 8% of total, so small part. Now the returns. So first, the returns, the important thing is that Better Finance, all our figures, return figures, are based on the total 100% of the market, not a sample or survey, and they are based on assets portfolio, not only on premiums. And here you can see that there is quite a good correlation between the unit-linked, what in the European jargon some people call MOPs, multiple option products, but are also called unit-linked insurance. You will see that there is quite a good correlation with our capital market benchmark, 50% European bonds, 50% European equities rebalance every year, but with a huge gap. And the main tool, which is capital guaranteed insurance, has been doing great for pension savers until 5 years ago. It's much linked to the, of course, the evolution of interest rates. So why the red line? That's the next slide explanation. So the two main reasons is that the units, in unit links you have units that are mostly promoted, sold, sometimes called advised. 90% of the market are first quite expensive. This is the example of French equity units, which is an asset class that is very popular in France, of course, in this contract, is close to 3%. And that does not include entry fees, switching fees, and portfolio management fees, or sometimes called mandate management, which are growing now more than 30%. A third of these unit links are under managed portfolios or mandated delegated management, and this typically you can add another 0.3% per year. And the other reason explaining the very poor performance of unit linked is so the cost is about 5 to 6% to 6 times, the cost charged to capital guaranteed insurance that you saw on the previous slide. The other big reason is the selection bias. As you can see here, the units that are advised are not the ones that provide the best performance. It's my understatement. And in terms of, because of time, I will not comment further on the figures. By the way, as you can see, it's from an independent research institution called Good Value for Money. If I go to, so that's for the main part of the pension savings market, which is life insurance. If I go to the just a little snapshot, an interesting one on the public employee insurance-based pension, which are were up to 2019, the payout was only mandatorily in annuities. And what you can see is that these annuities have been very little revalued on a nominal terms. Cumulative over 21 years, only by 4%, and sometimes 0, and sometimes even negative. The problem is, as Sébastien showed you, inflation over the 23 years has been quite superior to this 4.3%. The end result is a loss of purchasing power for these schemes of 27% to date. So two explanations. One is that these schemes are invested more than 80% all the time in fixed income, very little in equity. And second, there is a big governance issue. Most individual pension products in France are governed by independent association where participants must have at least half of the governing body. But this is not the case. It's an exception for public employees, the lucky guys. So it resonates also with the indexation issue that has been raised, for example, for Dutch pension funds, and I'm sure Matthias will comment on that. But so it's not only a Dutch problem. If you see this slide, it's also in other member states. Lastly, the overall results. Sorry for the people who are physically present, want to see. But again, you have you saw the capital guaranteed insurance. You saw the in blue this time the MOPS, the unit linked insurance. Interestingly, and that relates also to the comments of Sébastien, the not so bad performance is from the long-term defined contribution corporate plans, which are also quite correlated to capital markets, as you can see, but are doing much better than the unit linked. These are the facts, and I will welcome a discussion on what we can do to fix that and how to make sure you get a decent pension and at some adequacy. Thank you.
Thank you, Guillaume. If there's again one burning question right now, please feel free to raise your hand or ask in the chat. Otherwise, we will move on to the next person presenting. Any burning questions? No. We'll move on to the Swedish case, which will be presented by Johan Florén, who joins us on the line from Sweden. Johan, the floor is yours.
Hello, thank you. I don't have any slides, so you can. I don't know. I see the slides from before. Maybe you don't. So anyway, my name is Johan Florén. I'm Chief ESG and Communication Manager at AP7. It's a pleasure to be here. I'm gonna tell you a little bit about our product and our thinking behind it. So I started at AP7 in 2009, and at that time we had a different product as the default alternative within the premium pension system. So the product we have today is from 2010. And if I just say a word about the system, we are pillar one, but the public pension in Sweden is divided in two parts. It's an income pension system and a premium pension system. And the income pension system is a pay-as-you-go system. So the expected returns are very closely related to the Swedish economy. And the premium pension system is a funded system. And it's a political compromise, you might say, between the right and the left that was agreed in the 1990s. And so it's trying to balance different objectives. And one part of it was a fund platform that was introduced from the beginning, where all the savers can put together their own portfolio. And this platform grew in a way that perhaps not everybody expected from the beginning. So a couple of years ago, it was more than 800 private funds there to choose from. And a lot of problems came with that. So now it's reduced to 400, and it will be reduced even more down to a couple of hundred. We are the default alternative, so that means that either you land with us because you don't make any choices at all. Everybody starts with 87. Or you stay there because you don't want the private funds, or because you think that we have a good product, simple as that. So today we have somewhere around 6 million Swedes that have their money with us, and somewhere around 90 billion euros asset under management. So in 2009, the product was still pretty much a global equity fund with a home bias and a little bit of fixed income. And at that time, the politicians, of course, decided to give us new instructions, and we should develop a more sophisticated product. And one part of that was, of course, the life cycle profile. And if I go into a little bit into the product, it's actually a combination of an equity fund and a fixed income fund. So by combining these, we create a portfolio that can change over time. And the equity fund is created by some of our fundamental beliefs. One of the fundamental beliefs that we think suit us is diversification. Very important. So we invest in a little bit more than 3,000 companies around the world. Another conviction is low cost. So when we started in 2010, we had a fee at 15 basis points. And then as we have grown, we today charge 5 basis points for this global equity fund, which is, of course, one of the, well, actually the lowest in the system if you look at the product itself. Another conviction is that returns are closely related to volatility. So if you want high returns, you had to accept a higher volatility. Or if you turn it the other way around, if you're sort of have a strong conviction around low volatility, this will limit your returns substantially. And one of the things that we were allowed to do in 2010 was this life cycle profile. And I think one of the big benefits with this, and nobody wants a lot of volatility when they have retired. And this is very obvious. And you just have to follow the debate in Sweden. As soon as pensions start to go up and down, there's a lot of bad opinions, sort of. So you want low volatility when you have retired. And if you create a life cycle profile, the point is sort of that you have to have very high volatility before you retire. So when we created this product, we had a global equity fund and leverage. And from the beginning, we even had 50% leverage on this equity fund. So that means that when markets were going up, we got 1.5 times the returns. And of course, you always have to take circumstances into consideration. And this is not a level that you want to stay on sort of as a fixed level, but at the time, this was very helpful. So. And then we step by step developed the product, so we diversified in more ways. And one thing was to diversify the risk in itself. So we took the leverage down to an expected long-term level of 25%. And for a number of years now, it has been 15%. So the equity exposure has been 115% of the equity market. So and the index that that regulate our investments is the MSCI Active. So it's both developed market and developing markets. And I think that every country and every fund has to find their own solutions. So in no way this is the only way to do it. And it's not that I would recommend that everybody should have a life cycle profile or anything like that. I know this is going to be one of the questions we debate. However, I think that if you have money like we have for 40 or 50 years, and that, I mean, that's the thing. We know that the people that have the money with us are not going to use it for 40 years. It's very unwise to have too low volatility, since it's, in the end, you're just going to get a lower pension. And this is one of the main ideas with having the life cycle profile, to be able to give people such high volatility while they're not going to use their money. They can have a better pension with low volatility when they retired, and they're going to take the money out of the product. I should also say that part of this, of course, is that the premium pension is one part of the public pension system, and the other, the income pension system, is closely related to the Swedish economy, so it's much more bond-like. So we know that all our savers have one low-risk form of pension savings already. You probably don't want to put everything you have in a high volatility solution. So I guess I've already used my 10 minutes, and we can have the rest and the questions after. Thank you.
Thank you very much, Johan. I have actually one question in the chat that I'll put to you straight away. On retirement, do individuals go it alone, or can they still stay in the funds? Is the question.
Yeah, so we have the default where the absolute majority of savers are, but we also have 5 different other products. So if you want to choose, you can stay with the leveraged equity fund. This has to be an active choice, of course. We also have 3 fund portfolios with a mixed combination between equities and fixed income. So it's sort of a high risk, medium risk, low risk alternative. And if you should choose, you could, of course, put all the money in the fixed income fund. This is not something that we recommend for the simple reason that you have a lot of money saved when you retire, and the expected life is at least 20 more years. And if you have all those money in just pure fixed income, this will hurt your total returns substantially.
Okay, thank you very much, Johan. We are now moving to the last country case of the Netherlands. So the floor is yours, please.
Yeah, thank you very much to Better Finance to invite us to say a few words about the Dutch transition from DB to DC. I'll first go through the transition and then try to link it to the topic that we're discussing today about returns and costs, because DB to DC is, of course, a different kind of discussion. What is the starting point in our current system? We're right in the transition, which should be concluded by the 1st of January 2028. The Netherlands has a strong multi-pillar system. I represent pension funds in the second pillar, which currently invests about 1,500 billion euros, which is around 150% of GDP. But having such a big second pillar basically allows us also to have a quite generous first pillar in terms of coverage. So everybody has a first pillar independent of your income, and it's a basic pension, which basically gives a replacement rate at minimum wage level. And then the second pillar is there to provide a decent replacement rate for everybody who's making more than minimum wage, leading up to a net replacement rate, according to the OECD, of around 90%, and only 3% poverty in old age. Mercer does an annual pension ranking and put us back on number 1. So that's the starting point. And what is the current DB contract looking at the moment? I think it's very important to stress that already there's no sponsor support, and actually it's a DB promise that is conditional on investment returns. So from a financial risk perspective, it is already operating a bit like a DC contract. So EIOPA likes to talk about the massive shift of risks from employers onto individuals. That is not the case. The financial markets returns will translate more directly to individual capitals. That is true. So the effects will become more direct, but on a collective level, the risk more or less stays with the participants. So if the system is working well, why change? And this is a 10-year-long, 13-year-long discussion. So I'm going to cut a few corners and just mention 2 issues. The first is trust in the system, and what the 2 graphs show is that in the mid-2010s, the coverage ratio was around 100%, 30% on average, even going below. Some pension funds had to cut benefits. There was no indexation of inflation, while at the same time assets grew. And what we see is the impact of the interest rates on the discount rate, essentially making it not possible for pension funds to provide for indexation. And this is very hard for people to understand. Again, we're talking about 1,500 billion euros collectively, so it's really, there was a national discussion. What should be the discount rate? Different groups are arguing, based also on their own interest. So that is something we want to, we want to reduce the influence of the interest rate on the system. And the second part, and it's a bit more technical, but in the old DB system, accrual was age independent. So if you're 25 years, you put €1 and you get the same DB promise as if you're 64, which is from an actuarial point of view unfair, because your euro at 25 can still accrue returns for 40 years. This is fine if everybody just has a job. First you're subsidizing and then you're being subsidized. But if you leave employment and become self-employed at 45, this is unfair. So we're not throwing out the baby with the bathwater. We're keeping a number of the strong tenets. So mandatory participation will continue to exist for the vast majority of employees, and also depending on which contract is chosen, because there are two, there's still a significant degree of collectivity and risk sharing. So what is changing? First of all, we're banning new DB accruals, but more importantly, or just as important, most pension funds, we expect, we're quite sure, will choose to convert DB accruals into DC capital in order to make sure that we will not have two systems running at the same time. DC accruals become age dependent. I mean, this is logical in a DC system. It's capital that accrues returns. So that's typical. And there will be two contracts. One we call the solidarity contract, and one the flexible. Most industry-wide funds, actually pretty much all will choose solidarity contracts. So this means that the vast majority of Dutch employees will be covered by that contract, which means still collective investments, no investment choice, a variable annuity. Now, this will be something that people will have to get used to, because we always told people your pension's fixed. You can rely on that. That promise was, challenged by the falling interest rates. But now we will make the annuity variable. However, there will be still sort of a buffer fund within the pension fund to make sure that that the effects of financial market movements are smoothened over time, so that pensions will not be affected too harshly. We're also adding some new features. Pension funds will have to conduct a risk preference survey in order to ascertain how risky their participants will want to invest. And they will have to provide choice guidance. So even if there's no investment choice, there's still choices you can make about your retirement age. Sometimes you can get additional insurance. You can choose to save even more than the mandatory required premiums. Pension funds will get a requirement to guide their members and beneficiaries through this process. How this will be implemented is still very much being discussed in the sector, and pension funds are dealing with this. But now to try to bring it back to the discussion that we're having today, what does this all mean? And I don't own a crystal ball, so it's of course a bit of speculation. But in the end, I think the main long-term objective of this is to keep trust in the system. Basically, we're asking people to put away 20-25% of their income over a certain minimum level in a pension fund. So we have to make sure that people continue to trust the system to keep it mandatory. In terms of returns, there are different opinions in the sector, and maybe pension funds will take different approaches. There are those that might take the strategic asset allocation and pretty much keep it the same. There are other voices that argue that there can be a shift towards a bit more of a risky assets to reduce the non-fixed income element. What changes ultimately is that the coverage ratio will be no longer the main target that you steer for. So we saw a lot of liability-driven investments, LDI, with a lot of interest rate hedging. Now, for people close to retirement, you will still want to hedge interest rate risks, but less so on the sort of the longer for longer maturities, which maybe creates a little bit of space for more investments in equities. Probably not a huge, because on the long maturities, swaps are just more than bonds. It has to be said. The old system also had risk-based capital requirements. So on top of the 100%, in order to provide for indexation, there was a risk-based capital requirement, which is now gone, which will make it easier to invest in certain categories that were penalized by those capital requirements, like mortgages. Illiquid assets already play a fairly significant role, and they will continue to do so. So there might be some shift, but probably not a huge shift. Costs, the transition itself does cost a certain amount. I mean, this is the conversion of accruals is something that has to be done in a very careful manner. We have to update IT systems, and also we do a lot of communication. But in the long run, I think it will costs will remain at their relatively low level. Ultimately, pension administration and investments will not really change much. And then the final question, coverage. I mean, what the Netherlands does fairly well is solve this challenge of distribution. We don't have distribution costs, and the social partners take a decision about the appropriate level of premiums that have to be paid. But there's an increasingly growing group of self-employed people in the country that are not covered. So going to DC might make the system somewhat more interoperable, but probably other measures are needed in order to reach that group. And there is a discussion whether there should be something around auto enrollment or mandatory pension for other groups that are not covered. Perhaps we can touch upon that discussion as well. Thank you very much.
Right, thank you very much, Denise. So that was that for all the presentations. Thank you to all the speakers for your presentations. We can start the debate. For this, to guide the debate a little bit, we have prepared 2 questions, which Sebastian will come to you.
Yes, basically, we have 2 sides of the same question. As representatives of retail investors and savers, the finance, we want to, as the Commissioner McGuinness said, I would say, get a fair deal for investors. So I have 2 complementary questions. First is, how can we improve the gross returns, the performance of the investment themselves before charges and even without that inflation? And we've touched upon the question of the life cycling approach, adapting the investment mix to the age and the investment horizon of the savers. Should such approaches be implemented across all pension saving products? How can that be done? Do you think it's compatible with systems like the Dutch one, or the Swedish one, or the French one? And the second question, moving one step further, is how can we improve net returns? And what strategies can be used to limit costs for members and policyholders? Is transparency of costs alone sufficient for achieving this goal, or do we need something more? And of course, behind my question is a pricing process that is proposed by the Commission with a investment strategy. Maybe, Mathis, you would like to start since you were the last speaker with us on that.
Yeah, thank you. Those are two very relevant questions. So the first question on, should we have a life cycling approach? A very simple, easy answer. Probably something of that sort. I mean, a life cycling approach can be explicit or implicit. You will see sort of a pension fund with an older population will naturally be invested more in fixed income than a pension fund with a younger population, even if you don't have a formal life cycle in the pension fund. In our flexible contract, there will be a formal life cycling approach. In the solidarity contract, there will be not. The question is not just should you have that approach, but also, perhaps even more important, what is then the appropriate level of equity versus fixed income and other asset classes. It's easy to say just go 100% equity till you're 55 and then transition into bonds. I think it depends on what percentage of your projected retirement income are we talking about. Is it a small top up, or as in the Dutch case, is it half or even more than half of your income? And in the latter case, 100% equity might be, or even with leverage apparently. It might be a bit risky. In our case, we also think that some risk sharing within the pension fund can increase returns because it helps to smoothen the impact on variable annuities. But I mean, I don't represent retail products, but I know that there are retail products and maybe even some second pillar products that are mostly fixed income, and that to me indeed doesn't seem like the right approach. If you want me to take the second question as well, or
maybe we let Johan react to what you just said. In the case of Sweden, Johan, are you with us?
Yes, I'm with you. No, but I totally agree to the extent that every system is unique and everybody has their own conditions that have to influence the solutions. So in no way I would say that we are sort of a one size fits all solution. Yeah, but if you look at it at a principle level, you have to accept that there's a connection between risk and return. And if you are too risk avert, you will end up with a low pension. And if you look, I know that if you compare different systems, some of them have very little risk and it's not just equity and things like that. It's just in general, it's very much fixed income and low volatility products. And if that's what you want to have, fine. But I think that you should consider that pension systems around are under pressure to deliver and not consume for future generations their ability to just both consume while they're working but also have a retirement that is decent, and a pension system in itself is a solution to bounded rationality. If if everybody would be 100% rational, we wouldn't need pension systems at all, because everybody would start saving at 20 years of age and be perfect when they're 65. But they don't. So I think that you still have to allow a certain amount of risk to be able to give people a good pension.
Maybe you want to comment on the situation of France?
Yeah, no, it's a very good question. As you know, economic theory and Nobel Prizes will tell you on a gross return basis, the key driving factor is asset allocation, indeed, on the gross basis. So what can we do? What is striking is that still, and I put AP7 separately, when you look at the US retirement assets allocation in EU, the difference is striking. In Europe, life insurers portfolios are more than 80% in fixed income, and even pension funds, they are overall above 50%. That is not the case in the US overall. So there is, of course, maybe a different appreciation of risk, but I think there are three things that can be done. So on the global asset allocation by asset classes, definitely the US are doing better. I was getting a message of I think someone was online that fortunately he had invested in the US individual retirement account, and so he got a 9% nominal return per year. I did that too, but we are lucky guys because we've been working in the US, so we could open an IRA. It's not open to everyone. So overall asset class, one way to tackle it, as it was said, I think by Matthias, is going more to life cycle with the nonsense you said. It's maybe not the same life cycle profile for everyone, but I think that is one solution. And the other solution, when you look at the more micro asset allocation, is already at the gross return level to make sure, especially for personal pensions and life insurance, that you eliminate the selection bias. You saw the result in France of the selection bias, even at the gross return level. If you systematically pick the highest price funds, you will have a problem over the long term. The last thing to tackle this risk return challenge, we have been proposing for many years that people, where they will need less volatility, and they will need not to be governed by investment choices, which they are getting very old. And what we have proposed in France, notably, is to have a default option when you reach, let's say, 80 or 85 years old, which is roughly the life expectancy in Europe, or before, if it's your choice. Before or at retirement, you opt by default for a deferred annuity. A deferred annuity that will trigger at 80 or 85. So if you are, let's say, lucky and you are above the average life expectancy, the downside is that usually you are tired, you are not always in good health, you have more costs, often because of your health, etc. You are tired, you cannot think about what will I do if my pension income is moving up and down, etc. So peace of mind and security, that's, I think, another thing that should be looked at. Thank you.
Thank you, Guillaume. I just would like to interrupt just a second because I believe Johan needs to leave very soon. So if anybody has any pressing questions for Johan right now, that would be the time.
I have one, and but also Matthias, feel free to comment on this one as well. Just taking a step even back from already the very big question of the pensions time bomb and how to ensure retirement, and looking even from farther away at the savings and the role of capital markets in the economy. Sweden, especially, but also the Netherlands, are quite good examples in Europe in doing a bit better in this, that even also outside the pension system, people participating in the equity markets, and on the other hand, equity markets that have a lot of assets and that does contribute the needed capital into the real economy, supporting growth and supporting better jobs, etc. To what extent do you think this is also owed to the pension systems, which have good coverage in these products with equity exposure, with a bit of capital market exposure? That to what extent, let's say, this participatory pension systems can actually lead to people improving their financial knowledge in general, and also for their other savings goals than going to the capital markets, and indeed the capital markets helping grow the economy, which also comes back to.
Okay, so if I should just give a short answer, I would say that it definitely has an educational effect when people get involved with their pensions. That was one of the fundamental ideas behind the premium pension system, and also one of the strong arguments for giving people a variety of private funds to choose from and be able to put their own portfolios together. However, there has also been clearly the effect that there is a small number of people interested who are becoming more and more educated and understanding, but there's a large group who does not, where you don't have that effect. And regarding the second questions, if the sort of the market is going to bring the costs down because people would choose the efficient alternative, something like that, it's clearly not the case with a large part of the population who are still not very engaged and informed and have very low financial competence. So I think that if you want a more sophisticated system, you have to have solutions for different groups of people with different knowledge about, asset management and financial. Thank you.
Thank you, Johan.
Can I respond to that?
Please.
I think it's almost a chicken or the egg question. Was there more trust in capital markets and therefore we have a pension system like this, or the other way around? And the answer is probably a little bit both. I think when we move to a DC framework and people will see every year, okay, this is my pension, I see a capital and it's growing, I think it will make them more aware. And I think in that sense, a pension system can play a role to create awareness if we provide the right tooling and communication tools for it. Often, we say we have to improve financial literacy, but if you think back about how you thought about school when you were 16, we did learn maybe about those things, but you were not so interested. Only once you start getting a wage, then you see, okay, hey, where is my money going? Or when you're about to retire, that you want to know, how your pension, whether it's fixed or variable, etc. So we have to do a good job in making sure that pension communication relates to the actual questions people have, the choices people can make, and it should not be about just throwing lots of information at people, which unfortunately sometimes is a little bit the approach of European regulation.
Maybe we could ask Valérie to react to that, because EIOPA is active on both financial education and transparency of their performance. So maybe you want to come in.
Indeed, and I'm going to be a bit brutal here. Much as I love consumer information and transparency, I do believe that we need very much to tailor this level of information to exactly what was said just now, what people want to know and need to know. And I think across the board, there is probably a need to simplify communication, to make more use of new technologies, i.e. to I'm searching for the word, to use technology to make it a bit more on demand. So you'd have your essential knowledge, and then you could have layers of information which you can access digitally. And I think it's quite an interesting debate to wonder whether the reason that is explaining the low penetration of pension products, is that due to financial education? Is that due to an awareness issue? Because when we talk about transparency, there's transparency upfront about, you know, what the choice is, what the options are, you know, what you might have already in your pot, etc. But there's also transparency about the products you actually hold. And there is a wide discrepancy of standards in Europe today in terms of, you know, that some countries are actually forerunners, and you know, we had the Netherlands as an example. Now, this is a market where, you know, findings indicate that you get a lot of information about your pension entitlement, and you can contrast that with member states where actually you get told nothing until very late in the day, or you might be receiving very sketchy information about the potential products you hold. So I think that it's a combination, you know, how much information you receive, when do you receive it, and ideally you receive it, you know, well ahead in order to make decisions. But also, I would say, and I would agree, that there is a need to simplify this information, not only to cater for very diverse levels of financial education, but also to cater for investor preferences. I mean, some people want to know a lot about the products they're holding. They want to have a lot of detail to understand what type of assets, the mechanisms, their strategies. Is there a life cycle strategy? Yes, no, otherwise, what's the level of risk, etc., etc. Some people don't want to know and actually are quite happy to rely on a professional managing, and they just want to have the essentials. You know, how much is in my pot today? What does that look like in terms of a projection at retirement? But for me, keeping on adding disclosure requirements, and essentially believing that more transparency is the answer to all our pleas, that's ignoring the outcome of a lot of the consumer testing that EIOPA does, precisely with a view to advising on the right level of transparency and the right way to be transparent. So both in terms of the quantitative, but also the qualitative approach. So I think there's a lot of improvement that can be done in this area as well.
Thank you very much. We have a few questions in the chat. I will read out the first question. I believe this is directed to all of you. Do you have any experiences with temporary instead of lifelong payouts? If yes, are there any noticeable differences with regard to the amounts of payouts? I don't know who would like to take this question.
I mean, no, we have that. Currently, it's lifelong annuity fixed at the moment. So we don't have experience. There is the option, people can choose a sort of a high-low annuity, so that in the first years you have a higher annuity because you're still young, you're more vibrant, you can still travel, and then as you get older, you can choose a bit of a lower annuity. That is something that people can choose in the Netherlands.
Thank you. I will put the next question. If I understand EIOPA's publications correctly, pension funds tend to invest predominantly in their country of domicile, and government bonds are a large part of their portfolios. Doesn't this mean that the combination between Pillar 1 and Pillar 2 pensions in terms of risk and return? It is situated differently in Sweden and in the Netherlands. Unfortunately, we no longer have Johan with us, but perhaps
I'm happy to come in to say that, well, basically we've had a look at the numbers while the question came in the chat, and there seems to be a higher than average allocation in certain member states where above 50% of the government bonds invested in are domestic. But otherwise, if you look at the EU average, the percentage would be 17%, 17. So I'm not sure it's that material or that important if you take the EU average.
Thank you very much. Anybody else like to add to this response?
I mean, in the Netherlands, we invest on, I think, at a sectoral level, around 13% of assets within the country, which I think is relatively speaking, a fairly small home bias. But I think a lot of those assets are more in real estate, mortgages, where there's a clear link with the country. I think for bonds and equities, listed equity, I think the home bias is a lot smaller, if not just market weighted pension funds.
Yeah, well, I think it's a good question, but overall, our suspicion is that there is a home bias, but also a European bias. We have figures, for example, for French institutional investors, so-called institutional investors, so mostly insurers. So not only, as I said, there are very little in equity, but in equity, about more than 80% is in European large cap. You can see what European large cap have done over the last 20 years, for example, vis-à-vis world equity portfolio. That is not good for people. And I heard very happily, Johan, for 87, that their benchmark is world equity, and they are invested in more than 3,000 worldwide companies. And that's what pension savers need.
Thank you, Guillaume. Somebody is asking for clarification on the new Dutch system. What is happening to retirees in receipts of pensions in DB schemes, which is now moving to DC?
Their accruals will also be converted into a DC capital. So their annuities will become variable. I think a lot of the focus of the pension fund in the first years will be to keep the annuities fairly stable, because it is a lot about trust. So if we would move to the new system and then immediately people would see their pension being cut, this would not be good. But in principle, for nearly all pension funds, for active people but also retirees, we will convert the accruals.
Thank you very much for that, please. We can go to the second question, I believe, or that you had prepared.
Well, I think we already covered it in part. The question was, can we basically reduce the costs for pension fund members or holders of life insurance policies, and whether transparency is sufficient? Does it drive costs down, or is more action needed to drive the cost down?
You like to answer
Oh.
the question?
With pleasure. I will be very quick. For me, there are 5 ways to raise net returns. So we discussed about how to raise growth returns. The first one, indeed, well, I would not even start with costs, but I would start with the, especially for personal pension, as I mentioned already, the selection bias. You've seen the unit-linked or MOBs in France. Of course, there is the cost that we should drive for more cost-efficient products. And all this is linked, I think, to the debate in the retail investor strategy to end conflicts of interest, and indeed to improve the transparency on returns and costs And especially for pension, I would insist on disclosing real long-term returns alongside the nominal ones. For now, or for many years, only OECD and Better Finance have been doing that, and I'm happy that EIOPA and ESMA are now also picking up on that. But there are, I think, at least three other factors where we can work on. First is what economists call financial repression in taxation, which is part of it. The central bank's policy and EU government's policy of having in the recent past negative interest rates has hurt pension savers terribly. But also taxation. Usually taxation is punitive for personal pensions because it is taxing nominal return, which is today largely fictitious. And so in France, for example, on all life insurance, people are taxed more than 100% of the real income that they get. Two other things, governance. Governance is key. As I said, in France, for personal pensions, they have to be subscribed and governed by independent associations composed of only of the pension participants, and pension participants must have the majority in the governing body. In the US, mutual funds mandatorily have at least two independent board members representing investors. In Europe, we are very, very far from this. That creates a lot of problems. Another one problem it creates, and it's a problem, it's my last point, is this problem that is called by economists agency ownership, other people's money. And so this is managed by, they manage your money, but who bears eventually the risks and the rewards? It's you, and the beneficial economic owner is you. We want also effective, sustainable investing, and for this, we need badly these agency owners, pension funds and others like insurance, etc., investment managers, to engage and not to disengage, to actively exercise the shareholders' rights, which in fact are our rights that we have delegated to these people. And I would like to make a link to Better Finance recent report on transition investing, because transition investing is key for the sustainability of our planet. And transition investing, you can only do it if you engage with the brown companies. Green companies, it's done, it's good, but the economy is mostly brown right now. Thank you.
Thank you. Valerie, would you like to add to this question?
Yes, indeed. So the exam question is, improving net returns, limiting costs, etc., etc. So at EIOPA, we're working on a number of tools, but may I say my toolbox does not comprise any magic wands or silver bullets. I apologize. We're working on something a bit more pragmatic. And I guess if I had to sum it up, I say value for money. And value for money is precisely the initiative which has an issue not with cost per se, but undue costs. And the whole idea is that transparency is nice and sunlight can be a good disinfectant, but it's not sufficient. And quite frankly, in some cases, it does not work because there is a limited sensitivity of consumers to information. So the problem must be tackled upstream. The problem must be tackled at the manufacturer stage, and make sure that value for money is embedded in the governance of product development, but also as distribution phase. And we often hear, you want to impose cost caps, you want to introduce price regulation, etc., etc. No, the idea is not to go, that's not a race to the bottom. We do want our insurers to be profitable and solvent. Thank you very much. That's going to be good for everybody. But what we don't want is consumers to be taken for a ride. Therefore, what we want to ensure is that we provide sufficient tools for manufacturers to use as part of their product testing to benchmark themselves already with their peer group in terms of their products. But we also want to equip supervisors with these tools that will help them supervise value for money, because currently the framework that exists in IDD is very much principle based. So we do believe in regulation, but we also strongly believe in supervision, and that's why we are spending a lot of time and effort to build this methodology, to consult on the methodology, to make sure these tools are effective, so that ultimately consumers, when they make a choice to purchase a product, and whether that's for long-term investment, whether that's for pension provision, but it's all the more important if it's a product that is going to be held for a very long period of time, that they're not going to be afflicted with undue cost, which will eventually eat a significant portion of the return on the product. That's why it's so important to us that this tidying up is done at the very start by the manufacturer to limit the potential of consumer detriment. So yes, this is something that's been picked up by the Commission in the retail investment strategy, but quite frankly, we're working on it now, and the basis exists already today, and that's IDD. So whatever happens with the retail investment strategy doesn't change the fact that we are working on this now. We will be consulting in the new year on the methodology. We are working with the supervisory community to address this problem here and now without waiting for potential changes in regulation.
Thank you very much. Baptiste? Yes.
Yeah, I think I agree with almost, or perhaps even everything that has been said. Costs are relevant, and you cannot manage what you don't know. So first, you have to have a framework. Our framework for cost reporting is 120 pages long. It seems very easy, just report on the cost. But if you start to go down into the nitty gritty and fund structures, netting, taxes, it is quite complicated. But you can do it. And then the second question is, who is the agent that you refer to that can do something with it? In the Netherlands, once all funds started reporting on a comparable basis, we started seeing these consultancies doing benchmarking exercises, and some funds saw that they were being relatively expensive for their participants and decided to consolidate. So we've seen the number of pension funds drop dramatically from, I think, even 1,000 10, 12 years ago to 150 now, and people are saying will be 40 left within 10 years or so. Economies of scale pay off, but only once you know. For us, the individual participant has somewhat of a smaller role in that. Again, this is we want to provide information that people can act on, and the asset management fees of their pension fund is just not something they can act on in most cases. But there where people do have a choice, they do have the right to have comparable information on their product, be it second or third pillar.
Thank you. We have a few minutes left, and we have actually two other contributors to our pensions report. One is here with us, Jan Sherwood, and then online we have an old contributor who is Lubo, who is online, and I would invite you to perhaps contribute to the debate or have any questions you may want to the speakers. Yeah.
Actually, really quickly, while there has been many ideas, presented this morning, however, I'm really glad that after 10 years or 11 years, we finally found a product we would like to save in. And clearly, it's a Swedish one. We heard how it's managed. However, we also heard some strange things from my point of view as a researcher, is that if you choose a different way, what different way? We have analyzed like hundreds of products, and the other ways are wrong. So, okay, we can leave people, just okay, this is what we have chosen for you. So my also question and my suggestion for future research and adding some more value, we know the benchmark. we will compare it against the picture. However, we still don't know to what extent the deviation from a best in class, whether the deviation is because of the cost, because of the asset allocation but chosen by the agents, pension managers, or by the individuals, or by the regulation. And I'm afraid that the regulation plays a key role. Because for example, in countries eastern from Prague, you have really strict rules on how you can invest. So basically, at the very end, the politicians are deciding where your retirement saving goes. And this would be also my question to the Dutch scheme, just one, maybe technical one, but we have allowed in our system since 2005, I guess, these risk questionnaires. So basically, we had a predefined, really big funds, equity funds, but we let the pensioners to decide on their risk profile. What has happened? You had in equity fund people who were 25 years old and who were like 55 years old. Those who were 55 years old, they said, well, I don't like short-term risk. I don't like it. You have a 25 years old who said, well, I don't know, I don't care. So basically, the risk profile of the equity fund was 70% bonds and 30% equities. For whom this fund was suitable? For nobody. Therefore, my question to you is, why are you asking this question? If you have so different age profiles within one fund, and even want to make it solidarity. So a 25-year-old should lose his potential return from equities and shift it to an older person who doesn't like equities, but at the very end he will receive more return because there will be more equities. So what do you try to achieve with this, asking this kind of question on risk profiles of your savers? And at the very end, they are all in the same fund.
Well, I think to start off, I don't think it was our sector that asked for this risk preference survey. You're right. There are many challenges with these. How do you do this, and how do you then translate this to a collective level? Because that's what we're talking about in the solidarity fund. And some of these people working on this say, okay, the first thing you have to avoid when you do a risk preference survey is to use the word risk, because people will go, I don't want to run any risk. There are people who tell us, well, why can't I just save on a bank account instead of, why do I have to be invested? So that's challenging, and luckily, the legislation doesn't say that there should be sort of an automatic translation between the outcomes of this survey and the portfolio. So it's still in the end up to the pension fund board to decide on the strategic asset allocation. There are other funny effects, perhaps, that you see that, at least I hear that in some research, they find that the older people get, the more risk tolerant they become because they already have a house, etc. So they will say, give me equity. And the young people say, I don't have that much, I want to be in bonds. So I think we can continue to be a bit paternalistic with our system. I mean, we tell people you have to save with us. And I think ultimately we will continue to decide based on what we think is good for them, with some input from members. I think it's Chatham House rule here. I mean, we don't vote.
Maybe in addition, because I also work at the Dutch pension fund. What Nicky said, it's not only the survey you put out and the results of that. You can also use scientific insights next to it, and also participants' heuristics together with those two kinds of data. You can make some risk household of your scheme. So it's there are more data points which you can use. So it's definitely not a one-on-one implementation of what they say, and maybe a bit more specific. We did the survey, and we're going to do it the second one. So, well, I can't tell you already the results of the second one, but the first one, actually, the difference between young and old weren't that much, as you just mentioned. So, I think it's a bit more nuanced than you think.
Well, that's the point, that we recognize the risk as subjective risk, and that should be viewed as objective, especially when designing to use schemes like the pension scheme. I don't care about subjective risk of one person. I need to look at the long-term risk, which is delivering the maximum possible, pension pot. So this is the objective risk. Nobody is, asking or basically testing the savers, for these kind of questions. Do you even understand what the long-term risk mean?
Yeah.
We are always asking, how would you feel if it goes down 10%? Well, I don't feel good, but I understand why I'm doing it.
Yeah, that makes it difficult to.
Thank you very much. I don't think Lugo is our contributor to the past Bulgarian case. But we also have Christian Gulic online, who is our German contributor for the pensions report. I don't know if Christian has any questions.
Thank you very much. No, I had already asked my questions on the temporary pension, because this is a model which could be introduced in Germany for the first pillar pensions, but simply we do not have any experience, and that's why I had asked this question. Thank you.
If there are any more questions, there is one more, sorry. I will put this to all of you as well. Are ETFs a popular form of investment in pension funds?
Question. That's the best overview of all the cases.
I'm sure for France. For France, you see that in the unit-linked market, the advised ETFs are only less than 2% of funds advised. And you've seen the result, actually. Constant performance. I'm not saying, ETF are the panacea, of course, but maybe 1% in your portfolio is a bit too low compared to, for example, what is done in the US. I don't know in occupational pension funds and non-insurance based, but for example, in France, for the little part of DC plans, there is very few. When we talk about ETFs and index ETFs, there are very few.
I think for Dutch pension funds, the exact vehicle is they're not that relevant. I think they typically invest in alternative investment funds, or use it specifically set up for them individually or for a group of pension fund clients. I don't know whether it would work if the big Dutch pension funds will start to trade billions on the ETF market, whether market makers would be able to absorb all of that easily. And so, but I think in the end, the costs of these specific AIS are very low as well. I don't think there's much to gain from that element of investors.
Well, we have arrived at lunchtime, which is served by Euronext as hosting us at a lunch as well. So for those of you
For the online
online, but thank you all for having joined. As mentioned earlier, we will be releasing the pensions report today, and it will be available to download on our website. And thank you very much for a great debate.
Thank you.